Okay. Okay, so hello everyone. Today I wanna talk to you about a really interesting topic, US and China relation. So there's a really huge breaking news today about the US collide with Japan to kind of conduct war game amid rising China and Taiwan tension. So it's really funny because earlier this week, US has sent like 1 million vaccine shot to Taiwan and this enraged China. And of course, it's actually not a really breaking news because we all heard about like, US, China, tensions, every single day. So it's not a really big breaking news. However, this situation is quite, more like in alarming because this is the first time in this year that US has um, collide with Japan to apply more pressure on China. Although this is like a really it seems tense. However, you need to know the fact that in economic perspective, this is just like the love-hate relationship between like lovers because China and US need to depend on each other a lot economy wise in order to grow and in order to um, kind of you know for kind of exportations, importations a lot. So um, today I'm gonna focus more on the currency pair USD and CNY currency pair, and also discuss a little bit about the currency war that come with these geopolitical tension, which mean that whenever the geopolitical tensions happen, the China and the US also apply some kind of monetary policy in order to apply pressure on each other. So first of all, before discussing more about the USD CNY currency pair, I want to touch on the topic about why China buy a lot of huge amount of US debt with treasury bond. So first of all, China, you need to know the fact that China has steadily accumulated US Treasury security over the last few decades. As of January 2021, the Asian nation owe up to 1.095 um, trillion dollars, or about 4% of the 28 trillion dollar US national debt, which is like more than any other foreign country except for Japan. Except for Japan. And as the trade war between the two economy escalate, later on both sides six additional financial arsenal, and even like some kind of geopolitical tension like this, as like said about like the Taiwan and China tension, they also seek some additional financial weapon to kind of apply more pressure on one another. So some analysts and investors fear China could dump like the treasury in retaliation, and that this weaponizations of its holding would send interest rate higher, potentially hurting economic growth. However, like, okay, so first of all, let's discuss a little bit about Chinese economic. So China is primarily a manufacturing hub and an export-driven economy. Trade data from the U.S. Census shows that China has been running a big trade surplus with the U.S. since 1985. This means that China sells more goods and service to the U.S. than the U.S. sells to China. Chinese exporters receive US dollar for their good sold to the US, but they need or yuan to pay their worker or store money locally. So they sell dollars they receive through export to get yuan, which increase the USD supply and raise the demand for RMB for yuan. So China's central bank usually gonna carry out active interventions to prevent this imbalance between the US dollars and yuan in local market. It buy the available excess US dollar from the exporter and give them the required yuan. So PPOC, which is the People Bank of China, can print yuan as needed. Effectively, this intervention by the PPOC create a scarcity of US dollar, which keep the USD rate higher. China hence accumulate USD as forex reserve. So here's the important thing you need to know that the China economy has been growing really fast these couple of decades. And this means that their currency needs to appreciate thereby. However, due to their manipulations of the currency, they can still grow at a fast rate at an export-driven country without keeping their currency too high. So China need for a weak yuan is really, important for their export-led growth, as I have already discussed. So yes, so China wants to keep its good competitive in the international market, and that cannot happen if the RMB appreciate. It does keep the yuan low compared to the USD using the mechanism that has been described. However, this leads to a huge pile up of USD as forex reserve for China. So so here's the question: why China can keep their currency low, but still keep the inflation in check? Because when a country keep the currency really low, then it makes their import more expensive, and thereby make inflation increase. However, China is a really kind of, it is full tightly controlled by the Chinese government, so it is able to manage inflation through other measures like subsidies and price control. Other countries, for example, like India, don't have such a high level of control and have to give in to the market pressure of a free or partial free economy. Actually, India can apply the same strategy as China. However, due to like the government structure, it cannot do as well as China. So the question here is China use of USD reserve can affect the US like in times of tension like this. So China has approximately $3 trillion in foreign exchange reserve as of June 2020. Like the US, it also exports to other regions like Europe. The euro forms the second biggest strength of Chinese forex reserve. China needs to invest such a huge stockpile to earn at least a risk-free rate. However, comparing the two, China still choose the US because the eurozone, although it's stable for 18 years now, there are still a lot of risks compared to it, especially like the dependency of the country in the eurozone. So as I discussed, US debt offers the safest haven for Chinese forex reserve, which effectively means that China offers loans to US so that the US can keep buying the goods China produces. Hence, as long as China continues to have an export-driven economy with a huge trade surplus with the US, it will keep piling up the US dollars and US debt. Chinese loan to the US through the purchase of US debt enable the US to buy Chinese product. It's a win-win situation for both nations. China get a huge market for its product and the US benefit from the economic growth prices of Chinese goods. Beyond the well-known political rivalry, both nations are locked in a state of interdependency from which both benefit and which is likely to continue. Yes, and the repercussion as for China holding such a large amount of US debt is that it can an excess supply of US dollars would lead to a decline in USD rate, which means when China decide to, sell the US on the market, then it can make the USD fall dramatically in values. However, China may not be willing to doing that like a large amount as it makes little economic sense. If China stop buying US Treasury or even start dumping its US forex reserve, its trade surplus would become a trade deficit, something which no export driven country would want as they would want to worse off as a result. The ongoing worries about China increased holding of the US Treasury or the fear of Beijing dumping them all on coal. So even if such a thing were to happen, the dollar and debt security would not vanish. They would reach other, votes. So the risk perspective for the U.S. So although this ongoing activity has led to China becoming a creditor to the U.S., the situation for the U.S. could it be not that bad, considering the U.S. the consequences that China would suffer from selling off the U.S. reserve. China wouldn't do this kind of actions. Even if China were to proceed with the selling, the US being a free economy, yeah, this is a really interesting part because the US can print any kind of money they want because they are the free economy, and it can also take other measures like quantitative, like easing. Although printing dollar would reduce the value of its currency, thereby increasing inflation, it would actually work in favor of the US debt. Real repayment value will pay proportionally to the inflation, something good for the debtor but bad for the creditor. So although the US budget deficit has been rising, the risk of the US defaulting on its debt practically remain zero. Effectively, the US may not need China to continuously purchase its debt, rather China needs the US more to ensure its continued economic prosperity. So, but the risk perspective for China, on the other hand, is need to be concerned about loaning money to a nation that has also the limitless authority to print it in any amount, print the money. I mean, high inflation in U.S. could have a reverse adverse effect for China, as the real repayment value to China would be reduced in the case of high inflations in the U.S. So willingly or not, China will have to continue to purchase U.S. debt to ensure price competitiveness for its export at the international level. So like China buying the US dollars is just a tool to help them keep with their policy of export-driven economy. Although sometimes in place of tension like this, and the U.S. economy is not that stable after the pandemic, the China can still do some kind of dirty trick by selling up the US dollar, make the US dollar depreciate, which is not really good for the inflation that has been incurring in the US economy for so long. So what's the bottom line here? So the geopolitical realities and the economic dependency often lead to interesting situation in the global arena. This is like the relationship between girlfriend boyfriend, love hate relationship. I mean, actually not that relationship, but more like love hate relationship. I'm sorry. So China continuous purchase of US debt is one such interesting scenario. It continued to raise concern about the US becoming a net debtor nation susceptible to the demand of the creditor nation. In the reality, however, it's not as desperate as it may seem. For this type of economic arrangement, it's actually a win-win situation for both nations. So even though they fight a lot with geopolitical situation, both countries know that need to depend on each other in every kind of like economic activity, especially with monetary policy. Although monetary policy can be used as a weaponization against each other, however, they not going to willing to go on in for it because it's gonna be like a disaster for both countries at the end. So yeah, so that's the end of the story here. Like the analysis here. So I'm gonna touch on up a little bit about the USD and CNY currency pair. So here's the Chinese manufacturing PMI that has been published just today. So yeah, so please wait for a little bit. Okay, so the PMI here in June 29, 2021, the actual PMI is 50.9, which is down, uh, you know, from May. So it is not actually not too bad, but not too good either. So the currency pair right now, USD and CNY, is around 6.4. I'm sorry, around 6.4 right now. Actually, it has been the lowest since uh last year. This makes sense though because the trade, because China depend a lot on manufacturing, and from the last year, the manufacturing and the logistic supply chains has been affected a lot, which means the trade surplus of China has been reduced, not has been reduced dramatically, and because of this reduce, they cannot freely just printing RMB as before, or else it's gonna cost the inflation will be increased really dramatically. That's why they keep their printing intact and not just and selling of USD intact. So it just had decreased from June last year, and now it's reached around 6.36 6.39 $1 per 6.39 yuan. And it seems like at the current level, the China People's Bank of China, CPOC, is quite comfortable with the USD/CNY range between 6.4, above 6.4. Yeah, because of course the China PMI have softened. This article has already highlighted this. And also this may be the situation, they're gonna keep it to be at this range for a couple of more months until there's some improvement in the manufacturing and the economic growth of China. Then at that time the USD CNY pair gonna increase more, because at that time manufacturing improve, logistic improve, but we still don't know about how the geopolitical situation gonna lead to. But as of for now, we don't see any kind of major disruption in the logistic chain of logistic and value chain manufacturing process of large country. Not major disruption yet and major transition yet. So we still expect China as like manufacturing hub of the world. And after the pandemic, the China probably government gonna try to keep their currency, devalue their currency as much as possible. So yes, so this is in the long term. I definitely think that depending on some like fundamental data, fundamental news, we can predict how the USD CNY goes. In the short term, it's gonna be just being this range around 6.4 to I think around 6.3 to around 6.4 maximum. So that's for it. I really hope that you guys can have a wonderful new day, and in the afternoon in the evening I gonna have one more video to summarize about the market yesterday and some more suggestion about the stock market for our Thursday. So as yesterday there are a lot of new economic data that we should look forward to. So in this afternoon video, I'm gonna discuss more about that. So thank you so much for tuning in, and see ya.